Hey guys, welcome back to Colt Research. Today we're talking about these new 25% auto tariffs, how they should normally affect car prices, and a move by the Trump administration that has a lot of economists, including myself, scratching our heads. This one goes a little deeper than just car prices might go up. We're talking about supply chains, price controls, inflation, and what happens when policy tries to override economics. So stick with me until the end, and let's take a look at what's going on here. And hey, if you find any of this video insightful, please hit that like button and subscribe. It helps out way more than you know. Alright, so here's the situation. Earlier this month, President Trump announced a 25% tariff on all imported vehicles and their parts, and these are set to take effect at midnight on April 2nd. This new tariff applies to finished cars, trucks, and all of the individual parts that go into making them, so engines, axles, chips, everything. Now this alone is a pretty big story, but there's actually a twist. According to the Wall Street Journal, Trump got on a private call with the CEOs of some major US automakers like Ford and GM and told them directly, do not raise prices in response to these tariffs. Now on the surface, that sounds like a pretty solid move attempting to protect consumers. But regardless of intent, it's basically a tug of war between political strategy and economic reality. Because when you look at this through the lens of supply and demand, this approach breaks some fundamental rules of how markets work. So let's review some concepts from my very first video on YouTube. What do tariffs actually do in an economic sense? Well, at their core, tariffs are a tax on imported goods, which you've probably had that definition beat into your head by now. But if you're a car manufacturer and you buy a transmission from Germany, and now you have to pay a 25% tariff on that imported part, well, your cost just went up. It's pretty simple. Now that cost doesn't just disappear. It has to go somewhere. In a market economy, it usually gets passed down the chain from producers to retailers to consumers. So you're going to most likely end up paying more at the dealership. From a supply and demand curve perspective, this looks like a leftward shift in the supply curve. In plain English, that means suppliers are less willing or able to produce the same quantity at the same price because their costs are higher. So what happens? Well, prices go up and quantity sold goes down. It's not just theory, it's how real-world markets respond when input costs rise. And that's what makes the situation so odd, because the Trump administration is essentially trying to interrupt that mechanism. The tariff raises costs, but he's telling companies not to raise their prices. Which brings us to a bigger issue here that I haven't seen many people talking about. Price controls. Let's call this what it is. Maybe not in the formal legislative sense, but in practice, this is a soft form of price control. It's the government telling private companies, don't raise prices or there might be consequences. Even if it's not an executive order, I can imagine that the pressure is very real. Price controls, whether it's a cap on gas, rent, or food, they're almost always implemented with good intentions. Usually it's to protect consumers from spikes in prices. But economists across the ideological spectrum have been warning about the dangers of price controls for decades. One of the most famous examples was during the 1970s under President Nixon. Facing rising inflation, Nixon implemented wage and price controls, a full freeze on wages and prices across the economy. And for a little while, it looked like it was working. Inflation stopped climbing. But underneath, problems were building up quickly. Demand stayed high, supply dried up, and shortages emerged. And once the controls were lifted, inflation surged back worse than before. It was a classic case of artificially holding down prices while ignoring the underlying causes of those rising costs. The issue with price controls is that they distort market signals. When prices are allowed to move freely, they serve a purpose. They tell producers where to allocate their resources. If something becomes more expensive, it's usually because it's in short supply or hard to produce. And higher prices attract more suppliers to meet that demand. But when you block prices from rising, you short-circuit that entire process. And you end up with mismatches between what consumers want and what producers can provide. In economics, we call this deadweight loss. The lost economic activity that results from not letting supply and demand reach their natural equilibrium. You might get temporarily lower prices, but it comes at the cost of product shortages, lower quality, and long-term inefficiencies. And that's the exact risk here. If automakers can't pass on these higher costs to consumers, they have to eat them, and they only have a few levers to pull. One option they have, cut profit margins, which, let's be real, Wall Street's not going to love that. And car manufacturers aren't operating on huge profit margins to begin with. This isn't like tech or finance where you see 20-30% net margins. The average net margin for major automakers like Ford and GM is usually in the 4 to 8% range on a good year. For example, Ford's operating margin in 2023 was about 6.5%, and their net margin came in closer to 4%. That means if they sell you a $40,000 car, they're probably making something like $1,600 in net profit, if that. Now, apply a 25% tariff to parts that make up, say, 30 to 40% of the car's total cost. Well, if $15,000 worth of components are imported, that's an extra $3,700 in cost per vehicle. That's more than double the company's net profit. So what does that mean? Well, if they try to absorb the full cost of the tariff without raising prices, they're no longer profitable. They're underwater on every car they sell. Stock prices fall, capital dries up, and you start to see plant closures, layoffs, slashed R&D budgets. It's the worst. This is why the idea of just absorb the cost isn't really viable. It might be politically convenient, but it's economically impossible, unless you're willing to tolerate bankruptcies or ask the government to subsidize the difference. So if automakers don't want to destroy their margins, what do? Well, option 2 is they can cut their costs somewhere else. And that usually means spending less on labor, fewer upgrades, cheaper materials, or some delays rolling out new models. In some cases, it means layoffs, especially at the supplier level, where profit margins are even thinner. And then there's option 3, which is probably the most likely. They just raise prices anyway. Maybe not all at once, maybe not in the most obvious ways, but over time, new model year pricing, premium trims, feature gating. And that's why a lot of analysts are projecting car prices to raise 11 to 12% by May. Now, if this ends up happening and US automakers don't face any of these consequences, it's kind of a big brain move by the Trump administration. In this situation, automakers get to keep their doors open and plausibly deny that their prices went up because of the tariffs, while the Trump administration gets to bank another win in the eyes of their supporters. I just want to reiterate, this tariff policy is not just going to affect the import of finished foreign vehicles. Most US assembled cars rely heavily on global parts. A car built in Detroit still depends on electronics from Japan, transmissions from Germany, and raw materials from Mexico or Canada. Tariffs hit all of that. And reshoring production to the US, that's a multi-year process. You don't just flip a switch and suddenly have a domestic supply chain. It takes land, factories, engineers, suppliers, permitting, certifications. It's an entire ecosystem on its own. So these tariffs most likely won't bring jobs back, at least not in the immediate future. No, in the short term, they just raise prices. Here's another part that makes all of this even more complicated. The Trump administration's economic message is centered on fighting inflation and reshoring American industry. But this move works against the first goal to serve the second. Tariffs are by nature inflationary. They raise prices. Telling companies not to pass those costs along doesn't change that. It just shifts the pain somewhere else in the system. Tariffs are by nature inflationary. They raise prices. Telling companies not to pass those costs along doesn't change that. It just shifts the pain to somewhere else in the system. So where does all of this leave us? Well, none of these options in front of us are ideal for everyone. Someone's going to pay. If it's not the consumer, it's the worker or the supplier or the shareholder. The broader takeaway is this. When government policy tries to override the pricing mechanism, whether directly through regulation or indirectly through this pressure, it rarely ends cleanly. Markets can be nudged, they can be incentivized, but when you try to force them to ignore cost pressures, all you do is push the consequences around until they show up somewhere else. So what do you think about all this? Leave a comment down below, and if you found this video helpful or learned something new, make sure to hit that like button and subscribe. I post a new video every day to keep you updated on everything happening in the world of finance. Thanks for watching, and until next time, have a good one.